Hey everybody, I hope everyone is doing well and had a good day. Today's video, we're going to review the E-mini S&P 500 5-minute chart for Wednesday, June 10th, 2026. Here's the daily chart, and what I want to talk about might be more clear on the 60-minute or 30-minute chart. We have the bull trend with 3 pushes up, so we may get a correction. We have a trend line break with the big bear breakout bar on the daily chart, June 5th, small pullback bear trend day, a pause bar, and then a second leg down. This was yesterday, so we have a bear breakout, a pullback, and a second leg down. Yesterday, it's a reversal bar on the daily chart. It's a weak stop order buy signal, so there's probably sellers above yesterday's high, but there's enough buying. The bar closed above its midpoint, so there's a reversal into the close of the bar. We can see that on the 5-minute chart. So there's probably buyers below yesterday's low. And what I want to talk about on, let's say, the 30-minute chart here. Again, this is context going into the day. Just really interesting. Here's the small pullback bear trend. It's a bear breakout on a higher time frame. And we see that on the daily chart. And what's so interesting about this reversal yesterday, if we measure the bear breakout, so from up here, because there was a gap down going into the day, so you can include this as the start of the bear leg, the sell-off. So from the start of the bear leg to the low close, you can call that leg 1. It's a bear breakout. It's probably going to get a second leg down. And then we can project this as a measure move down from the highest point of the pullback, which was yesterday's high. And you can see the precision at the leg 2 measured move. And it looks like it's perfect. It's actually off by, I think, 2 ticks on the E-mini. It's 2 ticks when we're talking about a big leg 1 equals leg 2 measured move on the 30-minute chart, or as seen on the daily chart. So it's really interesting and fascinating to see that big reaction, the buying at that measured move target. We probably bounced for other reasons, but that's one reason that I see the traders had to be taking profits on shorts and maybe buying to go long. But it ended up being a pretty strong reversal. And because of that, we know the market is now either in a channel or a trading range. It's kind of a big down, big up situation. The sell-off yesterday is similar to the small pullback bear trend on the 5th of June. In other words, what I'm trying to say is that this probably needs a second leg down, but there's enough buying here to disappoint the traders who sold down here. So this bull breakout might be strong enough for its own second leg before the bears get a second leg, but ultimately it's still a more bearish regime, and I'm expecting the bear breakout to get a second leg, and we'll probably get to yesterday's low, although not necessarily today. I remember looking at that this morning and thinking it's possible we get to the prior day's low, but it requires the day's range today to be, I think it was double the average daily range. So it wouldn't be too surprising, but it also is not all that likely. Now, for the 5-minute chart, the scaling looks okay. And then just one more point that I wanted to talk about. I'll get there actually on bar 2. Okay, so the context going into the day, I talked about the reversal bar on the daily chart. Yesterday closed above its midpoint, and we can see the strong rally on the 5-minute chart here. It's a pretty strong bull trend, spike and tight channel. We can draw a trend line. Maybe there's a bull trend line here, something like this. And the bears had a trend line break, and that's good for the bears. So for a major reversal, we have a trend, and the first thing we need is a trend line break. And we have a break of a significant trend line. We have consecutive bear bars closing on their lows. The bears got a couple of bars completely below the moving average. So these are all good signs for a major reversal. However, the trend is so strong, like I said, that the bulls may get another leg up. So it's not necessarily going to reverse straight into a bear trend. It's more likely going to evolve into a trading range, go sideways into breakout mode, and then maybe reverse. So as we go into the day, the bulls end up getting their second leg here late yesterday, and there's sellers at that high, and this ends up being important resistance. Gap down and bear breakout bar 1. Good for the bears, but context not great. It's kind of, again, big down, big up, big down. You can count 3 or 4 legs. Down here, there's a bear channel line with bar 1 testing the channel line. Because it's right on that support, the bears ideally would get another bar breaking far below the channel line to convince traders we're going a lot lower. And if they don't, well, it's just one breakout bar, and it is closing below the bars to the left, but we just had this strong rally, and we cannot ignore that rally. The importance of the rally is that it's a bull breakout. And in theory, traders selling for any reason, let's just say, okay, it's a bear micro channel, 73 to 76. Bears will sell above bar 76. It's a bad stop order signal bar to buy, so traders sell above 76 yesterday in theory, and they get trapped into a losing position. So when the market gaps down and opens right around that price, are the bears going to be eager to sell here, or are they trapped because they sold here, they had to scale in higher, and they're just happy to get out at break even, or maybe with a profit, maybe break even on their first entry? And let me back up, maybe the bears who sold above 76 or sold the close anywhere down here, they're trapped into a losing position. They scale in higher, and then on the open today, those bears are able to avoid a loss by exiting around their first entry break-even price and then with a profit on their scale-ins higher. So the bears may not necessarily be eager to sell here. And then bar 2, a big bull outside bar. Now bar 2 is the bar that reminded me I wanted to talk about volatility, bar size. The range of bar 2 is almost 38 points. And that's a really big bar for a 5-minute chart for the E-mini. And the one thing I wanted to say about that is volatility doesn't change the market's behavior. It changes the size of the bars. Like a 38-point bar is huge, and you don't necessarily change the way you trade when volatility increases or decreases, but you do change your position size. So what I mean by that is if you're used to trading, say, 1 or 2 E-mini contracts when the average bar range on the 5-minute chart is 5 or 10 points, then a 38-point bar is a problem because you're used to risking maybe 10 points and now you're risking almost 40 points on a bar. So that does change the way that some traders will trade. You have to either reduce your position size or you cannot take the trade, or you can trade maybe the micro E-mini instead, or the SPY if you have the margin to trade the SPY. The ETF is another good alternative to the E-mini, especially when the volatility is this big. The bars get this big, it's hard to risk 40 points on one trade. But the whole point with what I'm saying is that it doesn't change how markets behave. Just because the bars are bigger doesn't change how traders behave and how the algorithms are trading, how the algorithms are programmed. They're always programmed. This is my belief. They're programmed based on logic and statistical research, and they have a slight edge, and they're going to repeatedly do the same thing over and over. And the size of the bar doesn't really matter, although it may change the position size. If you look at this chart and you didn't have any labels, you didn't know what market it was, you didn't have the price axis, the vertical axis, or even the time, the horizontal axis, there'd be no way to know what market this is and what time frame it is, because price action is consistent and it behaves the same way up and down the time frames and across all markets. It doesn't matter. You wouldn't be able to tell if it's crude oil or Forex or a stock, and you really can't tell if it's a daily chart, a weekly chart, a 5-minute chart, because they all look the same. So the only thing that gives it away is the price axis and the time axis. So the whole point is that when the bars get big like this, of course, you either reduce your position size or cannot trade, but you do not change the way that you're trading. If you have a strategy, if you have a trading system that you're following, then it doesn't change the way you trade. We have 3 or 4 legs down, testing a channel line after a strong bull breakout, and then a big outside up bar on bar 2. So bar 2 is probably going to get a second leg up. Maybe we test higher in the range, but it looks like the market's in a trading range at this point. So traders are buying low near support, probably selling high near resistance. And the bulls end up getting their second leg, 3 and 4, bar 2. So from the low of bar 2 to the close, this is how I measure breakout signals. It pulled back to the low of bar 3, and then the low of 3 during bar 4, the bulls reached their measured move target. So bar 2, it's a breakout, and then 3 and 4 is a pullback and second leg. Now it is a micro channel. 2, 3, and 4, there's no technical pullbacks, although we can infer there's an implied pullback when bar 3 overlaps bar 2 like this. It's pulling back on a smaller time frame, but we don't see the pullback technically on the 5-minute, which means bar 3 did not fall below the low of the prior bar. A micro channel is a breakout, and most breakouts get second legs. The first reversal down will probably fail. So bar 4, there's probably traders buying below bar 4. It's not an ideal place to be buying because it's probably closer to the upper third or middle third than the lower third of this trading range. So not an ideal location. But if you're buying here, you must be buying momentum because you're buying above the moving average in a trading range. So the traders buying down here are buying value. If you're buying up here or even below bar 4, you're buying momentum, expecting the bull breakout to get a second leg for the first reversal attempt to be minor, lead to a pullback, and then again a second leg up. So we trigger the stop order sell below 4. It's a bad sell, and the market continues higher. The bulls get a small second leg here. Traders buy below bar 4. They probably scalp out above bar 4 as well as we start to channel, and we're at resistance. 7, another outside bar. Probably buyers below 7 and sellers above 7, mostly going sideways here. 9, it's a reversal bar, but it's a relatively small bar. Good location for selling. If you're going to sell bar 9, it's at the top of a trading range. However, it's a fairly tight bull channel. Small pullbacks here. And the signal bar is small, which means you're getting great risk reward. Very small risk. If you sell below 9, stop above 9, target the low of the range, you're making many times your risk if the trade works, which means you have low probability. It's a higher probability scalp, or the higher probability trade is to fade the breakout, to buy below bar 9, expecting at least one more leg up and maybe to exit above bar 9. The problem with selling bar 9 and a stop above 9 is that your the stop loss order doesn't really make sense above bar 9, because if you're a bear selling below bar 9 and you put a stop above bar 9, what you're saying is that you're willing to be short below 9, but if the market gets above bar 9, that invalidates your premise and you're going to buy back your short. But you have to think through it logically and ask yourself, does it really make sense to buy above bar 9? Are bulls entering with stop orders above bar 9? And the answer is probably not. Why not? Because it's at the top of a trading range. We're at resistance. It's already 2 legs up, and it might even be 3 legs up. If we trigger the sell below bar 9, then technically it's 1 pullback, 2 pullback, 3 legs. And you know how channels behave. Traders buy pullbacks. They buy below bar 4. They're going to take profits and sell above bar 4. They're going to buy a pullback again and then take profits above bars again. So they might buy below 9, sell above 9. So it does not make sense if you sell bar 9 to put a stop above 9. It makes more sense to sell below 9, use a wide stop, maybe a measured move based on the height of bar 9, maybe even more, but be willing to sell more higher, because it makes sense to sell above bar 9. It does not make sense to buy above bar 9. You can also wait for a second entry short because the channel up is tight. And again, bar 9, it's only a reversal bar. You can wait for a breakout signal. So we trigger the sell below 9, and then the market goes up on bar 11, another bull breakout. Bar 11, the bar itself looks strong. It's a good breakout bar. However, we have to consider leg count and context. We have 3 legs up, 1, pullback, 2, pullback, 3. The market is attempting to break out above all the bars to the left. Bar 11 broke out above the bars to the left. That's good for the bulls, but they need one more bar. It's like I said with bar 1. Bears broke out below all the bars to the left. Good for the bears, but they need a follow-through bar, and they did not get it. Same with bar 11 here, but opposite. For that reason, because it's leg 3 in a trading range environment, this might be a better signal for selling than buying. Every trade has an opposite. Traditionally, you have a bull breakout bar. Traders will buy and look for a measured move in the direction of the breakout. But if it's leg 3 in a trading range, traders might sell to close bar 11, put a stop, a measured move up, and a target at the low of the bar. And to me, that makes more sense here in this context. And then market quickly reversed, 12.13, reaching that. The limit order bear, the trader selling the close 11, they probably take profits below bar 11, and that leads to a bounce on 13. Now think about 13. Bar 13, it's a high one buy setup. It's a great looking bull bar closing on its high, but the context is still bad. Now it's leg 4. 1, 2, 3, 4 legs up, top of a trading range. The bulls just failed to break out of the trading range. If anything, there might be more traders selling above bar 13, betting that leg 4 will fail, and this channel, draw a trend line here, market's channeling up, it's going to more likely evolve into a trading range, go sideways, probably come back and test the low of bar 5. So there might be more sellers above 13. And then the sellers come in above 13, and then 15, we get the bear breakout signal. Now the bears have the breakout bar. I was saying, you could sell 9, but better to use a wider stop and sell above the bar as well. Or just wait for the bear breakout signal, which we don't get until bar 15, but now we get it on bar 15. Structurally, the bears have an argument for a major reversal, and even worst case for the bears, it's just a broad trading range. So we have I kept the bull trend line here, bull trend line break, and a couple of retests of the trend's extreme. Market's going sideways here, and now we have a pattern of a top here. It's a nested 3 pushes. 1, 2, 3 pushes testing resistance. It's a nested 3 pushes testing resistance. You have 1, 2, 3 pushes here, but also the 3 legs up we talked about here. And now we have a reversal and a bear breakout signal, 15 closing on its low. So 15, if you're long for any reason, it's reasonable to exit below 15. And if you are flat, it's also reasonable to sell below 15. The bull, there's always 2 arguments. So we have to think about, what do the bulls have for an argument to buy bar 15? Well, we do have a spike and channel bull trend. And now maybe the bulls see this as a 2-legged pullback, maybe even a 3-legged pullback, wedge, bull flag, bull breakout, maybe 1, 2, 3 pushes down to this bear channel line, and they can buy the close 15, front running the bull breakout, expecting another leg up from here. And then instead, we get a bear breakout bar 16, and it's really interesting what happens here. So I said, there's always an argument for taking both sides of the trade. Traders who buy the close 15, they get a bear breakout bar for their entry bar on 16. So what are those traders going to do? Maybe they scale in lower, and they're able to avoid a loss when bar 17 goes back and tests the close of 15, their original entry. So if a bull is quick enough, they buy here. Maybe 16 is disappointing enough that they just exit the trade on the retest on 17. Now the bear breakout is growing. It's a 4-bar bear micro channel, probably sellers above 17, might even be sell the close 17. The bears have pretty good structure, like I talked about. Big picture, probably a trading range, probably going at least to the low of bar 2. And then we have to take into consideration the average daily range. And what's the range of the day at this point? Can the range double? This is including today. The average daily range on the E-mini is 80 points. So what's the daily range up to bar 12? Basically the opening range. It's about 70 points. So the day's range doesn't have to grow very much. It's already close to an average daily range here. But bear micro channel down to bar 17. Second leg down, likely. Trapped traders above. And then we got a give up bar on 18. Now a possible measuring gap from the start of the bear leg to the breakout point of the possible measuring gap. So there's a target here. 18, probably sell the close, going at least a little bit lower. We pause, we test the breakout point, and then the bears continue to get followed through. And they reach that target fairly quickly within 4 bars. And then there's a reaction, a bounce at that measured move target. So do we have a bottom here? And is bar 23 a good buy? Probably not. You can count 3 pushes down, micro channel down to 16, doji bar, pause, breakout bar 18, another pause, and then a third push down to 22. And also that the measuring gap, measured move that I showed here. But the micro channel is too much price control and time control to expect this to be the bottom. For there to be a bottom, a trading range, or reversal into a bull trend, the bulls first need to break a significant trend line and then get a retest of the bear trend's extreme, the low. So 23, it's a trend line break. It's a breakout bar, and it may get a second leg sideways to up, but it's the first bull breakout signal in many bars. The last bull breakout signal was bar 11. So it's been over 10 bars since there's been a bull breakout signal, this one occurring after a strong bear micro channel. And if you ever heard me do an end of day review, you know what I'm going to say. Bear micro channel, it's a bear breakout, so expect a second leg down, expect a minor reversal. So traders might be selling above 23, selling the close at 23, expecting it to fail to reverse the micro channel. Traders will sell above bars. They'll sell above the last strong bear bar, in this case probably 21, expecting a test of the low. In other words, a second leg down. Low one short 24, but strong enough bar 23. There are traders who sold above 22, sold the close 22. They're trapped by 23. That creates temporary support. Like I said, 23 might get a small second leg sideways to up. And look at 24 through 26. 3 pushes. 1, 2, 3 pushes down to support. Smaller time frame, bull breakout, wedge bull flag, double bottom, testing support area where traders got trapped. And this may lead to a bounce, a second leg sideways. And that's what we get on bar 27. The bulls get a breakout, a pullback, and a second leg. What about buying 27, double bottom? There's your second entry. The bears got their second leg down. The problem here, and I've been thinking about this for a while, I'm still trying to figure out a way to talk about it and articulate it in a way that makes sense to other people. I talk about the pullback of the pullback. The question here is the bear micro channel getting a second leg? Is 24 through 26 the second leg down for this micro channel? Or is it the pullback of the pullback? So bear breakout, bar 23 is a pullback. You have to assume that 23 is a pullback after the bear breakout, but it's a strong enough breakout bar. And because price action is fractal and you get the same patterns up and down the time frames, when you get a breakout on 23, even though it's a minor reversal, and it's probably not going to reverse the market straight immediately into a bull trend, you have to respect the trapped traders on 22, 23, created by bar 23. And that leads to this pullback and support down here. So bar 23 is getting a pullback. So what I'm trying to say is that I'm not convinced that 24 through 26 is the second leg down from this bear breakout. I still think the bear breakout, this big micro channel, 14 through 22, needs a better second leg down, more symmetrical second leg down, similar in size and energy than 24 through 26, which leads me to believe that 24 through 26 is a pullback of the pullback. So breakout, pullback, pullback of the pullback, second leg of the pullback, and this is setting up a low 2 for the bears. Bear breakout, low 1, 24, and then low 2, 27. 27, similar but different context as bar 11, another bar that might be a better fade, even though it's a bull breakout bar. So maybe traditionally you expect bull breakout to get a second leg, and you buy the close, look for a measured move in the direction of the breakout. In this case, it's against a strong bear trend, and it's a second leg testing resistance. What about the traders who bought above bar 23? Just put yourself in the shoes of those traders who bought above bar 23. Your entry bar is a bear bar closing on its low. That's disappointing. Just again, imagine you bought here and you're still long and you're disappointed, but you're scaling in lower, and then 27 gets back to your original entry. Are you eager to buy at this price, or are you just happy to exit at break even on your first entry and with a profit on your lower entries? So to me, it looks like the bulls are scalping out using bar 27 to take profits, and bears have an opportunity to sell the close, betting on a failed bull breakout and ultimately looking for trend resumption. Bear trend and a low 2, looking for trend resumption. 28 big outside down. It looks like we're continuing to go sideways here for about 8 bars. Let's see if the bears can get trend resumption. But instead, the trading range is continuing. We're getting buyers below the big bar, 28. 29 reversal bar, but closing around its, not around its midpoint, but big tail above 29. There might be more sellers above. I said it's a trading range, and maybe this is general resistance. This is general support. So trading range, you can expect traders to buy low and sell high. So the market gets back to resistance. Now we have a low 3, bear trend, low 1, low 2, low 3. Possible trend resumption here. But a lot of overlapping bars here, once again, especially 31 and 32. 3-bar micro channel, it'll probably get a second leg down. We get a trend line break and a second leg down. Tight trading range, closer to support in this trading range, and a second entry long after this small micro channel. So 36 might get a small second leg, but there's probably resistance above. 37 a bull breakout bar, but back to resistance, the moving average, and then the upside probably limited because of the trading range here. Now we have a micro channel, so the first attempt at trend resumption may be minor, may fail. Maybe the bears need a second entry short. 39, a pretty decent bear breakout bar. Not an ideal place to be selling because it's in the middle of this tight trading range, but big picture, you have this big bear trend, and then a trading range, possible bear flag before trend resumption. The market's in a trading range. There's just no doubt about it from probably bar 23 to 39. This is, I want to say objectively, it's a trading range. The market's going sideways. We've got a lower low here, but we've got a higher high here. Now we have range compression, lower highs, higher lows, lots of overlap, and mostly just going sideways through here. So this is a trading range, but it's happening after a bear breakout. And the question again becomes, has the bear breakout gotten a second leg down? Maybe it got a minimum second leg breakout, 2-legged pullback, second leg 28, but still nothing that resembles the size and strength of this micro channel. A lot of time control and price control. Is it only going to get a 1-bar second leg? And is it only going to be about half the range? Who knows? But to me, it looks like this is a trading range. And for this to be a major reversal, I'm not sure if the bulls have done enough. It might be close to 50-50, but because the trend is down going into this trading range, I think it's slightly more likely we get the bear breakout. And because of that, I'm looking to sell during this trading range. I'm less eager to buy. You can buy and sell when the market's in a trading range. But because of the bear breakout leading into it, I'd rather look for sell setups. 39, this is the whole point with that, is that selling 39 is not ideal. It's in the middle of the tight trading range, but bigger picture, bear breakout still may get a second leg down, so it might be okay to sell 39 if you're looking for a swing. And then bar 40, testing the bottom of the range. It's also probably close to a measured move of bar 39. That might create support. The market bounces. Plus, I said the micro channel, that'll probably get an attempt at a second leg. The first attempt at trend resumption for the bears will probably fail. So buyers below 36 makes sense. Bulls have a second entry long, 42, so the market might bounce here, but probably continuing to go more sideways than 43, forcing you to buy right in the middle of the range. And I just kind of explained my thoughts on that. I think it's better if you're going to enter in the middle of this trading range. I think it's better to look to sell because the bear breakout down to 22 still needs a second leg down. And as far as the major reversal, the bulls did break the bear trend line. There's a bear trend line. Market went sideways, and the market can break a bear trend line by either going up or by going sideways. In this case, it's gone sideways. It's gone sideways for enough bars that it could reverse into a bull swing and then test near the high of the day. And there's arguments to be made for that. We already talked about the average daily range being 80 points. The daily range at this point is about 100 points. So we've already covered the average daily range. It's possible that we have a low of the day. Again, there's always an argument for both sides, but it's just hard to ignore this, what is probably the most dominant feature of the day, the sell-off down to 22, and it still has not had a second leg. And also, through here, this entire trading range, except for one bar closing above the moving average, this entire trading range has been below the moving average. So to me, it still looks like the bears are more in control. So breakout bar 43, but context not great for buying. And then another bear bar 44. Again, I think bears are still hoping every bear breakout leads to trend resumption here. Breakout follow through, probably going at least a little bit lower. Micro channel, probably sellers above. The first pullback probably will fail, so sellers above 46, 45, which sellers came in. Micro channel, sellers above, second leg down, 49. Now, the market's mostly sideways through here. We can count 3 legs down, so it's possible that we have a channel line that is acting as support. That's the evidence right now. Can the bears break below it? Bar 50. Breakout bar. Can it get follow through? There is a follow through bar, 51, but it's mostly overlapping the prior bar. It's not breaking far below the channel line. It's sort of a nested leg 3 also. Maybe bar 2 and then 22 or 29, leg 2, and then leg 3 down to 51. So not ideal for selling, probably better to wait for a clear breakout below these channel lines. 52, a big breakout bar. So we're finding support on the bear channel line, and now we're getting a big breakout bar 52, second leg up likely. There's trapped traders below. But there's also resistance above. Remember, back here, any trader who bought the close of bar 38, disappointed 39. They're holding a losing position. And we may hesitate here because any trader who bought here and scaled in lower and who knows where. Let's say a trader bought bar 38 and bought more at the new low of the day. Their average entry price is this midpoint between the entries. You buy the close 38, you buy more at the new low of the day. Your average entry price is the purple line, the midpoint. That's around the close of bar 52. So there might be some selling here, but enough momentum, 52, big breakout bar, probably buyers in the buy zone, and the bulls will probably get a second leg up. So we hesitate, and then the bull breakout ends up getting its second leg once again from the low of 52 to the close of 52. There's your breakout signal. Here's your pullback down to the low of 53, and then 53 through 55, the bulls get their second leg leg 1 equals leg 2, target reached, and then we're back near resistance. You have to ask yourself, do you really want to buy a breakout bar 55 when it's near a leg 2 measured move, near resistance in a trading range, and big picture, this big bear breakout still may get a second leg down? We got a bear bar 56, bear breakout bar closing on its low, near resistance, probably reasonable to sell below that bar, and if you're long for any reason, you can exit longs below 56. And then market continuing to go lower, big breakout bar 58, that's probably going to get a second leg down. Market's channeling down, 1, pause, 2, pause, 3, pushes down near support, so we may bounce here, but this is a tight bear channel. From 56 down to 62, this is a bear breakout, it's probably going to get a second leg down. Micro channel down to 62, probably sellers above. The market tried to hesitate, 63, a pause bar, but the micro channel continued. 65, bad stop order buy, probably sellers above. Same with 66. We finally trigger the buy above 66, sellers come in, and we get that small second leg down to 69, but still a tight bear channel. Now the bears might be getting their second leg down here. And the buying pressure since bar 56, almost non-existent, so another strong breakout, probably going to get a second leg down. Another micro channel, probably sellers above bar 71, 72. 73 is a breakout bar for the bulls, but the channel down is so tight. You know, there's trapped traders, and the first reversal here, the first breakout signal against this tight bear channel is probably going to fail. So it might be sellers above 73. 73 might be strong enough for a small second leg sideways to up. It's really similar to 23. Strong enough bar, maybe it gets some kind of second leg like that, but ultimately leads to trend resumption for the bears. It gets a follow-through bar, so we may find buyers below 74 for a second leg sideways to up, but this looks like a minor reversal so far. We're probably going to get a test of the lows. And that might be the second leg for the bulls, the big outside bar 77. Bull breakout, deep pullback, and then a second leg sideways. So now we're probably going to test back down to the lows. And this tight bear channel probably get trend resumption. And it does 78 into then following bars there. And then for a measure move based on this micro channel down to 22. So technically there's a pullback bar 14 went above 13. So from the high of 14 to the low close 22 to the highest point of the pullback, which is bar 28. Bear breakout, leg 1, pullback, leg 2 measured move here. And you can see the market reached it on bar 79 today. All right, that's going to be it for today's end of day review. Thanks everybody for watching, and for more price action fundamentals and how to trade price action, please visit the Brooks Trading course. You can find a link in the description of this video. All right, thanks again everybody for watching, and I hope everybody has a good night.